$6,700 every single year. And most retired Americans have absolutely no idea this money belongs to them. If you are watching this right now, there is a very good chance the IRS has been holding on to money that is legally yours. Not money you have to fight for, not money buried in some loophole that could get you audited. Money the tax code explicitly says you are entitled to. And the reason you have not claimed it yet is not because you missed something obvious. It is because nobody sat you down and explained how retirement taxation actually works in plain English. You worked for 40 years. You paid into the system. You played by the rules. And now that you are finally living on Social Security, a pension, maybe a 401k or IRA withdrawal, the IRS still has its hand in your pocket. But here is what changes everything. There are provisions in the federal tax code that exist specifically for people in your situation. People who are retired, people on fixed income, people between the ages of 60 and 72, and if you have not been using them, you have been leaving real money on the table every single April. I am going to show you exactly what those provisions are. I am going to give you real numbers, and I am going to tell you what to do before this tax year closes. But first, you need to understand what the IRS can legally do to you, and what it is already doing if you are not paying close attention. Here is the first thing most retirees do not expect. The IRS can tax your Social Security benefits. This is not a rumor, this is law. Up to 85 cents of every dollar you receive from Social Security can be counted as taxable income. That rule lives inside Internal Revenue Code Section 86. It has been there since 1983, and the income thresholds that trigger it have never been adjusted for inflation. Never. Not once in over 40 years. So every year, more retirees get pulled into that taxable zone without ever moving a single dollar of their income higher. The government calls this bracket creep. You call it a smaller check. Here's the second thing. The IRS requires you to take money out of your IRA or 401k once you reach a certain age, whether you need that money or not. These are called required minimum distributions, or RMDs. You must begin taking them at age 73 under the Secure 2.0 Act passed in 2022. The amount you must withdraw is calculated each year using IRS Publication 590-B and the Uniform Lifetime Table inside it. If you miss that withdrawal or take too little, the IRS can charge you a penalty. That penalty used to be 50% of the amount you should have taken. Congress reduced it to 25% in 2023 and to 10% if you fix it quickly. But that is still real money gone for a mistake that is completely avoidable. Here's the third thing. If you receive income from multiple sources, Social Security, a pension, part-time work, investment dividends, the IRS expects you to pay taxes on that income throughout the year, not just in April. This is called estimated quarterly tax. The deadlines are April 15th, June 15th, September 15th, and January 15th of the following year. Miss them consistently, and the IRS assesses an underpayment penalty using Form 2210. Most retirees do not know this form exists until they are already staring at a bill they did not expect. So why does no one explain this clearly? Why did your employer never sit you down and walk you through what retirement taxation actually looks like? Here is the honest answer. The system was not designed to make this easy for you to understand. Most of the information about these tax benefits exists in IRS publications. These are long, dense government documents written in language that most people need a law degree to decode. IRS Publication 554 is specifically titled Tax Guide for Seniors. It runs over 30 pages. It covers credits, deductions, filing thresholds, and exemptions that apply directly to retired Americans. And almost nobody reads it, not because they are careless, because nobody told them it existed. The tax preparation industry operates on complexity. The more confusing the code seems, the more you feel like you need to pay someone else to handle it. That is not a conspiracy. It is just economics. But the result is that the average retired American files a return that is technically correct, but leaves legitimate money unclaimed. There is also a timing problem. Many of these credits and deductions phase in based on age. Some kick in at 65. Some depend on your total income falling below a specific threshold. If you are not tracking both of those things simultaneously, you miss the window. And unlike a missed deduction you can amend later, some of these opportunities have hard annual cutoffs. This is forbidden knowledge in the sense that it is technically public. It lives in the tax code, in IRS publications, in the Federal Register, but it is written in a way that makes it practically invisible to anyone who is not a CPA or a tax attorney. You have been paying taxes your entire life. You deserve to know what these rules actually say. Here is the first section of what you actually need to know. The credit for the elderly or the disabled. This is a real federal tax credit. It is defined under Internal Revenue Code Section 22. A tax credit is not a deduction. A deduction reduces the income you are taxed on. A credit directly reduces the tax you owe, dollar for dollar. This specific credit can be worth up to $7,500 depending on your filing situation. You qualify if you are 65 or older, or if you are retired on permanent disability and were under 65 when you retired. The catch is an income limit. If you are single and your adjusted gross income exceeds $17,500, the credit begins to phase out. If you are married filing jointly, that threshold is $25,000. Most retirees assume they earn too much to qualify. Many of them are wrong. The credit is calculated on Schedule R, which attaches to your Form 1040. If you have never filed a Schedule R in retirement, there is a real possibility you have left this credit unclaimed for multiple years. You can amend a prior year return up to 3 years back using Form 1040X. That means if you missed this in 2023, 2022, and 2021, you may still be able to recover that money. That is the kind of number that adds up to several $1,000s. Real money, legally yours. Here is the second section. The higher standard deduction for seniors. This one is simpler, and it applies to far more people. When you file your federal return, you can either itemize your deductions, meaning you list out every mortgage interest payment, charitable donation, and medical expense, or you can take the standard deduction, which is a flat amount the IRS allows everyone to subtract from their income. For 2024, the standard deduction for a single filer is $14,600. But if you are 65 or older, the IRS adds an extra amount on top of that. For single filers, that additional amount is $1,950, bringing your total to $16,550. For married couples where both spouses are 65 or older, the additional amount is $3,900 combined. That is nearly $4,000 of income you never pay tax on, simply because of your age. This is not a loophole. It is written directly into the tax code at Section 63. The IRS does not advertise it loudly. The form does not remind you of it in flashing letters. But there is a checkbox on Form 1040, on line 13 under the standard deduction section, that asks if you or your spouse were born before January 2nd, 1960. If you check that box, the software or the form automatically increases your deduction. Many people filing by hand skip right past it. Many people using basic software never get prompted. Check the box, take the deduction. That is an immediate reduction in your taxable income that costs you nothing but attention. Here is the third section, the medical expense deduction for retirees. Healthcare is expensive. That is not news to you. But what may be news is how much of what you are already spending can be deducted from your federal return, and how the threshold that governs this deduction actually works in your favor as a retired person. Under Internal Revenue Code Section 213, you can deduct qualified medical expenses that exceed 7.5% of your adjusted gross income. That threshold applies to everyone, regardless of age. Here is a concrete example. If your adjusted gross income is $40,000, 7.5% of that is $3,000. Every dollar you spent on medical expenses above $3,000 is potentially deductible. That includes Medicare premiums, it includes dental work, it includes vision care, hearing aids, prescription medications, and even certain home modifications made for medical reasons, like grab bars in a bathroom or a ramp for wheelchair access. Retirees often have adjusted gross incomes that are lower than their working years, which means the 7.5% floor is lower in absolute dollar terms. And healthcare costs in retirement are frequently higher. The result is that more of your medical spending clears that floor than you might expect. You claim this on Schedule A as an itemized deduction. The critical thing to understand is that you need to compare your itemized total to your standard deduction, including the senior addition we just discussed, and take whichever one is larger. Run both calculations before you file. Do not assume the standard deduction is automatically better without checking. Here is what you need to do right now, before this tax year ends. First, find last year's Form 1040. Look at line 13. Check whether you indicated your age correctly. If you were 65 or older and the additional standard deduction amount was not reflected in your return, you may have an amendable error. File Form 1040X within 3 years of the original due date to claim what you missed. Second, locate Schedule R. If it is not in your tax records from the past 3 years, ask yourself whether anyone checked your eligibility for the credit for the elderly or the disabled. Pull your prior returns. Compare your adjusted gross income against the income thresholds we discussed. If you were under the limit and nobody filed a Schedule R, contact the IRS or prepare an amended return. Third, gather your medical expense records. Pull every explanation of benefits from Medicare. Pull every receipt from your dentist, your eye doctor, your pharmacist. Add the total. Then calculate 7.5% of your adjusted gross income. If your medical spending exceeds that number, you have a deductible amount sitting unclaimed. Fourth, if you are between ages 60 and 72, verify your RMD status. If you turn 73 this year, your first RMD is due by April 1st of the following year, but taking it that late means you will also owe a second RMD by December 31st of that same year. That double distribution could push you into a higher tax bracket. Spread it out if you can. Use the Uniform Lifetime Table in IRS Publication 590-B to calculate the correct amount. Fifth, if your income comes from multiple sources and you are not having taxes withheld automatically, set up estimated quarterly payments using IRS Form 1040-ES. Missing those deadlines triggers penalties that are entirely avoidable. The next quarterly deadline is the one you need to protect. If you found this useful, please subscribe. Every single week I cover what the IRS expects from retirees, the rules, the forms, the deadlines, and the credits that most advisors never take the time to explain in plain language. This channel exists for one reason: to make sure that after a lifetime of paying into the system, you finally understand how to get what the law says you are owed.